Hello and welcome to a special edition of Dealbook where we look back and as well chart the course for what is set to be, by all accounts, another year of M&A. The question is what parts of the market are going to feel that significantly, and alongside it pondering the Chinese connection following the signing of the free trade agreement, notably completing the trifecta for the Abbott government. First, of course, there was South Korea and Japan, and lots to play for, and inevitably lots to mull on the merger front coming into the future off the back of it. Well, to discuss all of this, my panel today, Simon Siegel, regular contributor, indeed my guest host all through Dealbook this year, from Deal Reporter, of course, joining me today. Alongside Simon, Tony Damian, partner at Herbert Smith Freehills. Gentlemen, warm welcome to you both, and as well joined from studios in Sydney CBD, Credit Suisse Chairman John O'Sullivan. So John, welcome into this discussion. Might just, as it were, get you off the rank firstly, John, and I suppose from your perspective at Credit Suisse, what has 2014 represented as far as a continuation, a push back into some kind of normalisation, more specifically, from what's been a pretty challenging few years? How do you sum it up?
Well, to borrow from the football commentators, it's been a year of two halves. The first half was a crackerjack half for M&A, and it looked as if M&A was back in business. The deal volume for the first half of the calendar year was about double the previous the figure for the previous corresponding half in 2013. But the second half fell off a cliff, and as a result the overall year-on-year comparison of 2014 to 2013 is pretty much line ball. Now, in the last month, in December, there have been some notable deals announced, although not completed. So there are some green shoots, if you like, but it's been quite a patchy year, and certainly too early to declare that M&A is back big time.
Tony, too early to declare trends, because this is what we'd like to sort of get a grip on, to see what might be present into next year that's started to kind of evidence itself when it comes to the nature of the bids, the hostile versus anything else, for instance. Now, on that score, what stands out to you?
I think the key driver, and John's made a good point, that there was a slight fall away in volumes in the second half of the year. The key driver, the key trend to look for is, will those volumes return? Because if the volumes return, then you will see more hostile bids, you will see more agitation in boardrooms to execute growth strategies, and that will drive the detail we'll see happening in the deals. What's
it down to? What does it come down to put those ingredients into play from the fall-off? What's missing? What are you waiting for?
I think what we will see is confidence is always the key word. I think boardrooms going into 2015, and importantly, not just in Australia, but we have to consider the boardrooms of potential bidders overseas as well. The world is volatile. Boardrooms recognise that, and I think the key question will be, do they have the confidence to execute disciplined growth strategies despite that volatility? My personal view is I think they will. I think the scene is set for an active year.
Simon?
But it's from a journalistic perspective, Carson, for you and I, it's been a fascinating year. It's absolutely gone in patches, and we've experienced that throughout the year, as you know, John and Tony have indicated, and that's to be expected. But there have been very interesting, particularly interesting deals, and particularly interesting sort of benchmarks. Our data shows, and our data is based on Australian listed targets of a bit of over 200 million American dollars, roughly. We've been covering 27 deals this year in that space, of which only 14 have completed. Obviously, some are still ongoing. Maybe 4 or 5 of them are still ongoing. We can perhaps talk about that later. But there were 5 deals that lapsed. So for hedge funds and for other parties interested, for risk takers and even for deal makers, there were enormous lessons in that. On the other side, there were of those 27, there were 8 rival bids. Our data has never come, as a proportion, it's never come remotely close to that. Warrnambool, you'll recall, Carson, we had great fun doing that. There were eventually 3 rival bidders, I think 6, 7 rounds of bids, of prices. So it's been a very interesting year. Only this weekend, there was another really interesting example in the bid from Iron Mountain for Recall. Now, Recall were able to get their an enormous amount of information to the markets very early on, in an extent of disclosure that I've never seen, you know, as part of its defence. They made calls to their major shareholders on Sunday. So that's another trend. You know, there's this trend of battling for shareholder support, illustrated by what Recall's obviously learns, well, you know, over the year. This was an important, it's been a big trend.
I think there's an important point Simon's just touched on, which is the attitude in the boardroom once a proposal is received, and for a variety of reasons, including the confirmation by ASX about when you have to disclose approaches and so forth. That's given target boards, it's that confidence word again, the confidence to sit back and assess proposals, to look not just at price but conditions. The regulatory space has been very important this year, and you do see situations where boards are prepared to come out and say, thank you for the interest, thank you for the offer, but at that price, that's not something we can entertain.
And even more interestingly, or to me, boards like, well, I can think offhand, there were 1 or 2 others, but Pan Aust allowed diligence to be done on the specific, you know, fiduciary statement that bid was, you know, it was insufficient on the basis on which they were doing diligence. So it's been beyond that. Yeah.
And if I could add another
Please
example, if I could add another very interesting example of the dangers for target boards or for incumbent boards of announcing a deal too early and then it not going through. SAI was a very interesting example of a deal announced and then no bid ultimately being made after diligence was granted. So, you know, obviously not a good result for the company.
In hindsight, you know, John, what actually might the board have done differently, given the market conditions can swerve one way and then the next? You know, what's been looked at in that data room might not look half as rosy one week to the next. It's largely kind of out of your hands, isn't it?
Well, certainly the disclosure rules, as Tony's pointed out, are out of your hands. If there is rumours in the market and volume is changing, you may have no choice but to disclose. But whether or not a board grants diligence and what reassurances they would want before granting diligence is a matter for judgment. I'm not second-guessing what SAI in particular did, but there are lots of examples where the right advice to a board might be not to grant diligence, not to take the matter any further.
There's been, to my mind, a noticeable rise, particularly towards the end of the year, of private equity coming back into play and doing just what John was referring to, which is that whole kind of rather tortured process of due diligence. Where, you know, when the rubber hits the road, Simon, do you suspect a lot of that was just a fishing expedition? That these are rival players in the same space, arguably looking at other businesses, but wanting to gain a competitive advantage by having that first-hand insight through, you know, kicking the tyres.
It's a very, I mean, John and Tony will know better than me, but it's a very expensive, cumbersome, time-consuming process to do due diligence if you're not serious. So those who got to the stage of due diligence, and there's diligence on the other side, they're not, if it's detected that a potential bidder is not serious, there's no point in going to the boardroom. So it's more than, at that stage it does go a bit more to tire kicking.
Yeah, look, 2 points to make on that, on private equity. I agree, personal experience, I think most of it is genuine. Views can differ on value. It's not great for a private equity house to develop a reputation as a tire kicker. I don't think most are doing that. The second point on private equity, and this is why I think it's one of the reasons next year will be active, is they're sitting on large amounts of money. That money will need to be invested. That's why they're looking at these companies. They've had some non-deals happen this year. They'll go back, work out why is that so, why didn't we beat the default position here, and they'll be back in 2015 to execute.
Yes, if I can emphasise, repeat Tony's comments and agree with them, it's absolutely true that the reputable private equity firms don't engage in diligence without serious intent and without first having had a serious look at the publicly available information.
Sure.
So they're very focused when they do it. I was thinking more about perhaps less credible buyers.
Sorry, it's a good distinction you draw. Just a really brief thought, because you did touch on ASIC, and we've mentioned it now kind of in a veiled way. The obligation to disclose, how has that been better defined this year? Has ASIC, as it were, made life easier for boards? Or where do we sit come the end of the year now on that?
Yeah, I think ASX has led the charge, and they've come out with very sensible guidelines around the continuous disclosure obligations. ASIC has happily followed the lead on that, and so both organisations have been sensible. As John points out, it's not always in the interest of companies or the market to just race out and disclose proposals that may not go anywhere. And so obviously we see proposals that do get approached, but you can rest assured there are many that don't get disclosed. It's difficult to talk about those,
Sure.
but I think the rules are working well.
Because as a journalist, Simon, just before we go into the break, does that rank as something that's part of another trend for you, that the leaks, the splashes in certain select papers ahead of the companies themselves going on the front foot? I mean, how would it rank this year?
That's been happening ever since print was invented.
Indeed, but would you say this year looks any more extraordinary than others, or no? It's as you say, it's just perhaps more.
Well, I would make a general observation in that M&A coverage in the media is far weaker than it's been. It's far less aggressive. It's far less. It's less pursued. Yeah. So on that side, and that's the general resources in the media.
Right, well, we are going to take a short break, because coming up on the show, we drill down into something on the outlook for you. We look ahead, some predictions that were made last year. We'll judge those in light of how things have measured up as well alongside. Do stay with us.